Welcome to this explainer. As a senior financial analyst, I'm constantly asked how we actually spot the real winners in the market. Well, today, we're opening up my exact trading desk playbook. We're going to cover exactly how to value equities, dodge those brutal valuation traps, and use AI to hunt down massively undervalued stocks.
Here's our roadmap for today. We're going to decode the PE ratio, look at the hidden drivers of value, figure out the right PE to use, learn how to dodge common valuation traps, and finally, dive into how we use AI for equity research.
All right, let's jump right into Section 1, Decoding the PE Ratio.
So the core question is, how many years of current earnings am I paying for today? I don't want you to just think of this as some dry math formula. Think conceptually. Ask yourself, how long does it take to recover my investment if this company's growth goes completely flat? It's literally the heartbeat of valuation.
Let's put some numbers to it. Say a stock is trading at 500 rupees and its earnings per share sits at 25 rupees. You are paying exactly 20 rupees for every 1 rupee of earnings. Basically, in a zero-growth world, it would take you exactly 20 years to earn back your initial investment. Makes sense, right?
Now, the formula itself is just price per share divided by earnings per share. But the deeper insight here, a high PE isn't inherently a bad thing. It usually implies the market is expecting massive future growth. Investors are willingly paying a premium today for bigger profits tomorrow. Or it could signal the stock is dangerously overvalued. On the flip side, a really low PE might flag a hidden bargain, or it might just be a dying company.
Moving on to Section 2, the hidden drivers of value. You see, a PE ratio absolutely does not exist in a vacuum. If a company has higher expected growth and a higher dividend payout ratio, that's going to push your justified valuation up. But if the required return, which basically means the underlying risk of the investment, increases, well, that forces the valuation down. It's this constant dynamic tug-of-war. Imagine comparing two real-world companies. Both have identical earnings per share, yet company A commands a much higher PE ratio. Why is that? Well, the market isn't just being irrational here, it's actively pricing in an expectation of either explosive future growth or significantly lower risk for company A compared to company B.
But what happens when you're looking at, say, a volatile tech startup that has both high growth and incredibly high risk? The final PE is totally ambiguous. It depends entirely on which force dominates Wall Street's expectation, and spotting which of those forces will win out, that is exactly where your analytical edge is really tested.
Okay, let's head into Section 3, the right PE to use. This is where rookies often trip up. They confuse which metric to pull. Trailing PE relies on the past 12 months of earnings. It's totally objective, sure, but you're basically driving while looking in the rearview mirror. Forward PE, on the other hand, looks ahead. It's far more relevant for spotting true value. But remember, it relies heavily on analyst estimates, and those can definitely be flawed. Context is absolutely everything here. For cyclical industries, think steel or real estate, a single boom year can make the PE look incredibly cheap, which creates a massive false buy signal. Conversely, a recession year makes it look insanely expensive. To actually find true undervalued gems in these sectors, you absolutely must use normalized earnings averaged over a full business cycle.
So, what's the golden rule on the institutional desk? We heavily weight our forward estimates to project value, but we constantly cross-reference that trailing data to keep our models firmly grounded in reality. You've got to synthesize both to make a truly bulletproof judgment.
All right, Section 4, Dodging Common Valuation Traps.
Here is exactly how retail investors bleed capital. They misinterpret what makes a stock cheap. First rule. Never use the PE ratio if a company has negative earnings. The math literally just breaks down. Also, if you blindly compare a hypergrowth software stock to a heavily regulated utility stock, or if you completely ignore a massive mountain of corporate debt, your analysis is going to be completely useless. To actually identify an undervalued stock, you have to compare apples to apples. A company's PE might look like a total steal compared to the S&P 500, but if it's not aligned with direct peers in its own specific industry, you're looking at a value trap. You should always combine PE with the PEG ratio to adjust for growth, and check the return on equity to verify they're actually generating real cash.
And finally, Section 5, AI for equity research.
This is a real game changer. Instead of manually updating these massive, clunky spreadsheets, we now deploy AI agents to instantly scan thousands of equities. We can surface abnormal PE mismatches, run rapid scenario analysis on growth and risk, and summarize 50-page earnings reports in literally seconds. It completely supercharges our ability to spot market inefficiencies.
For example, you can just tell your AI copilot, compare PE ratios of top IT companies in India and identify the undervalued ones. The AI instantly isolates the outliers and flags the mismatches. That saves you hours of manual labor, letting you focus purely on pulling the trigger on high-level decisions.
So, as you apply these institutional metrics and AI workflows to your own screening, I want you to engrave this in your mind. A low PE is an invitation to investigate, not an automatic buy signal. Always ask yourself why it's cheap before deploying a single dollar of capital. Are you finding true hidden value, or are you just walking straight into a trap? Thanks for joining this explainer. Keep analyzing, and I'll catch you next time.